Hey everybody, a lot of people have asked me my opinions on the news that Redfin is being acquired by rocket companies. I'm going to get into that in this video. Before I do, please take a minute and check the link you see on your screen, fool.com/Frankel. I'll put it in the description of the video as well. Fool.com/Frankel for you can get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So I'm going to share my screen real quick. So if you missed the news, let's just going to quickly go over what's happening. So Rocket Companies, which is best known for Rocket Mortgage, but there's a few other parts to the business, they are buying Redfin in order to create what they call a unified real estate experience. Essentially, a lot of companies, or several big companies, specifically Zillow is the big one, have been really striving to create kind of an all-in-one real estate platform for a while now, and no one's really gotten it right yet. So Rocket is using this acquisition to really kind of kickstart its all-in-one approach. The transaction is an all-stock acquisition, meaning that there's no cash involved. They're not paying cash for Redfin. Your Redfin shareholders will just get shares of Rocket. The deal valued Redfin at about $12.50 per share, but that was Rocket based on Rocket's share price as of the announcement. Since then, the shares, it's pulled back a little bit, so that's why Redfin's not trading quite that high. But Redfin investors will get, there's the exchange ratio right there, they will get 0.7926 shares of Rocket companies when the deal closes. So just kind of for context, if you own 1,000 shares of Redfin, you can expect to see about 792.6 shares of Redfin or of Rocket show up in your brokerage account when the deal is closing. So just a couple of the important details. Glenn Kelman, who is the CEO of Redfin, he's been the CEO for a long time, is going to continue to lead that business. Redfin has about 50 million monthly visitors and has about 1 million active real estate listings on its platform. So this provides an opportunity, and here's kind of the goal of the merger, is to match buyers of homes with Rocket mortgages. Both companies have a ton of real estate data, so there's a lot of ways they could potentially leverage that data to their advantage. And they expect a total of about $200 million of annual synergies, meaning, cost savings or benefits from the deal. Some of it's cost savings of combining two companies into one, and some are, benefits of being able to cross-sell products to each other's brands. So they expect a total of $200 million of annual synergies by 2027. So the big question that Redfin shareholders have to ask, because this is an all-stock transaction, they're not just going to get paid when the merger closes. They have to decide if they want to become Rocket shareholders. So if the answer is yes, there's nothing you need to do. When the deal closes, your Redfin shares will simply turn into Rocket shares at that exchange rate that I mentioned on the first slide. Nothing you need to do. If the answer is no, it could be time to sell. So just a little bit of a dive into what Rocket is up to these days. Again, they are best known as Rocket Mortgage, but they actually came from Quicken Loans. There's a lot more to this business. They were a subsidiary. Now they're kind of the main part of that business, but there's personal loans. There's all kinds of other stuff going on in there. Rocket's been in business for 40 years. They've done over $1.8 trillion of transaction volume. They are the number one mortgage lender in the United States, and they've served more than 10 million customers. So one of the big parts of the thesis is that the homeownership market in the U.S. is very fragmented. So, about $5 trillion is the size of the real estate market in terms of the transaction volume in a typical year. In other words, $5 trillion worth of homes change hands in any given year. Of that, about $2 trillion is the mortgage origination market. The mortgage market itself is bigger than that. It includes things like refinance loans and home equity lines of credit. But the mortgage origination market is about $2 trillion in size. And the top 10 companies, although Rocket's the biggest, there's a lot of room to grow here because the top 10 companies only hold about a 23% share of the market. Very fragmented market. That most people listening can't tell me who the number 2 mortgage lender is, and that's because there's not any big dominant players, including Rocket. They're not that dominant. We'll talk about that a little bit more in a minute. But the real reason that companies include like Zillow, like Rocket, like CoStar now are trying to create an all-in-one real estate platform is because the homeowner the process of buying or selling a house is not it's clunky. Even when it's working well, it's not a pleasant process. You can see just some of the stats here. At least 6 parties are involved in the process, like a mortgage lender, a real estate agent, the seller's agent, the buyer's agent, title insurance, the lawyer, the settlement lawyer. I could go on with those. The average home buyer pays $35,000 in transaction costs, and some could be paid by the seller. It takes 43 days on average to close on the sale of a home. Could you imagine if it took 43 days to close on an auto loan? It's just a really, really clunky loan. 25 different types of documents are involved in the process. So there's a lot of room to use technology to streamline real estate, and combining a big mortgage lender and a big tech-focused broker is a good first step. And you can see I was talking about how the mortgage market is very fragmented. Rocket is the number 1. This is Rocket up here. They have less than a 10% share of the mortgage market, even though they are the number 1 player in the space. So they could conceivably double and still have, just over a 15% share or so of the mortgage market. You can see in other similar industries like, stock investment brokerage, like Charles Schwab is the number 1. They have like 40% of the market. Intuit has, well over 20% of the tax prep market, and so on. So a lot of room to grow the share, even though they're already a big company. One of the things I really do like about this deal, in a way, I wish Redfin would stay as a standalone business, because I really do believe in what they're doing over there. But on the other hand, this deal does get rid of some of the things that I dislike about Redfin, specifically its debt and its lack of profitability. So you can see Rocket has been doing really well over the past year or so. Their business rebounded from the really terrible real estate market of 2023 into the okay real estate market of 2024, I would call it. But there could be a whole lot more to go. The market is still kind of agonizingly slow for mortgages, especially in refinancing. No one's refinancing a home right now. And adjusted EBITDA, they've been profitable for, in most recent quarters, especially in 2024. So this is a profitable business. They're absorbing Redfin, which is not a profitable business, and has a pretty high debt load relative to the size of its business. Rocket actually has a pretty clean balance sheet, so even with absorbing Redfin's debt, their balance sheet still looks pretty good. You can see right here a ton of liquidity. They have $8.2 billion of total liquidity, including, they have more cash than Redfin's current market cap. So really, really strong balance sheet. And mortgage servicing is a big focus of theirs, and that's a business that I really like just in general. It's really kind of, very low effort, it's really low effort, high margin fee income. You can see they have a lot of, their servicing portfolio is huge. It's generating $1.5 billion of recurring fee income. And like I said, with, very high margin revenue. So what am I doing to kind of sum it up? I'm holding on to my shares of Redfin for now. It's not a massive investment in my portfolio, but it's a decent one. I'd say it's like in the middle of the pack in terms of my investment size. So the deal does mean less explosive growth potential, especially because Redfin had been so beaten down in the terrible real estate market. But it does mean more stability. I like the synergy potentials. It eliminates, as I mentioned, some of the worst aspects of Redfin, like the excessive debt, lack of profitability. So for now, I'm holding on. If anything changes, I will be sure to let you know. But I do like, I like this deal. I think it's a smart business move although I would selfishly like to see Redfin stay independent and become my next 10x investment. It doesn't look like that's going to happen. So I like this deal. I'd like to know what you think. Leave me any comments you have. I would do my best to respond to any of them individually. And please stay tuned right now for a message from The Motley Fool. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.